hold until I'ma get lazy.
I'ma get lazy. Mic check. All right, let's do this. Yo, my name is Sebastian Salvela. So in my last video, I talked about the ROI on an investment property, the cash-on-cash return, and the total return, which includes the equity that you gain every time your tenants pay their rent. And I also talk about what's considered a good return and how a lot of investors use the US economy or the S&P 500 to kind of gauge how well their investment is doing. So if you haven't seen it yet, you should definitely check it out. I think you'll find some valuable information in there. So one of the things I mentioned in that video is that one of the reasons I prefer real estate versus other type of investments like the stock market is that you have more control from the beginning and you could force appreciation. So you might have thought, forced appreciation? What the hell is that? Well, let's talk about it. So I talked about appreciation before and how it's one way you can make money on real estate. So appreciation happens when properties go up in value over time. So a property appreciates based on the market and the cycle that it's in. So if you bought a property for $400,000 and 10 years later it's worth $470,000, then you've made $70,000 in equity without having to do anything. So that kind of appreciation is called natural appreciation and is 100% dependent on the market. You have no control over it. Now, forced appreciation, that's when you increase the value of the property yourself. So when you buy a stock, you buy it at a price and that's it. There's nothing you can do to influence the price of that stock. So whenever you want to sell at some point in the future, the profits that you make is completely dependent on the market. And that's not the case for investment properties. So after you buy a property, you can influence the value or how much the property is worth by doing a couple of things. But before we get into that, I want to define a term that you need to know and understand first. When looking at commercial properties, so I'm talking about properties with more than 4 units or commercial buildings like businesses, you can get their values by using what's called a capitalization rate or a cap rate. So the cap rate is the ratio between the net operating income and its value. So the net operating income is how much money the property is making without accounting for any debt. When you take all the income the property is making, so all the rent, and you remove all the expenses to operate the property like property tax, insurance, and maintenance, you get the NOI. So the NOI represents how much money or how much return the property is making. And the cap rate, it represents the rate of that return. So it's basically looking at how much money the property is making compared to its market price. Let me give you an example. So different neighborhoods have different returns or cap rate based on the economy, the specific market that they're in, income levels, school district, and so on. So you could easily get that number from a broker. So say you went to your broker and he gave you the cap rate for your specific block and you knew the NOI for your property, then you could easily calculate its value. So it's basically the NOI divided by the cap rate. So say that your cap rate was 10% and then the NOI was $15,000, then the value of your property would have been $150,000. So how does that apply to forcing appreciation? Well, if you could either increase your income or decrease your expenses, then you can increase your NOI. And if your NOI increases, then the value of the property increases. Say that we have $20,000 for your NOI instead of the $15,000 that you had before. Then the new value of the property is now $200,000. So just by increasing the NOI by $5,000 a year, you increase the value of the property by $50,000. So for commercial properties, if you can find a deal where you could increase the rent by either upgrading the units or the building to make it look better, or maybe adding a washer and dryer or reducing your vacancy, then you could instantly increase the value of your property. And similarly, if you can find a way to reduce your expenses by either reducing your water bill or your utilities, for example, then you can also increase the value of your property. Single family homes or 2 to 4 unit properties work differently. Their value is determined by the market or comparable sales or comps. And comps basically means other properties that are similar to yours that just sold recently. So the economy drives the prices up and down, and the comps sets the price. So if your property is a duplex and other duplexes in your neighborhood that are similar to yours recently sold for $300,000, chances are that your property is also going to sell for around $300,000. So figuring out ways to increase the NOI is going to be beneficial to your cash flow because that will be more money left in your pocket, but it won't increase the value of your property like it does for commercial properties. However, if you find something that's undervalued and you're able to do some renovations to it, then you can increase its value and force appreciation. So for example, say you pick a neighborhood where all the new updated 3-bedroom, 2-bathroom, 2,000 square foot, 2-car garage properties are all selling for around $500,000. And then while doing some research on Zillow, you find a similar property in the same neighborhood that's only selling for $400,000. So when you look a little bit closer, the reason that the price is lower is because either the seller doesn't know what they're doing, or you find that the property is a little outdated and a little beat up. So all the walls in the house are a weird color. So the carpets, the cabinets, the appliances, they're all old. The landscaping is bad. I mean, it just looks terrible all around. So you would go in and buy it and put in $50,000 worth of work into it to make it look like the other properties in the neighborhood. So by doing that, you would have increased the value to, say, let's go with $490,000. So by finding a great undervalued deal and knowing what type of renovations to make based on comps, you're able to increase the value or force the property to appreciate. So you bought it for $400,000, you put in $50,000, and now it's worth $490,000. So you basically gained $40,000 worth of equity in the property in a relatively short amount of time. And I think being able to do that is amazing. So whenever I talk about how I like the control that you get in real estate, that's what I mean. So you're able to affect value from the beginning. So you could go in and buy something that's undervalued and force the appreciation and basically get immediate return. You could choose where to invest. You could choose to use leverage to get a better return or to have more money available for renovations. You could choose what kind of renovations you want to make. You could choose what kind of tenants you want to live in your place and so on. So by having that type of control, you have more options. And by having more options, you're able to choose what's best for you. So that's all I got for today. If you think this video was helpful and you want to support this channel, make sure you like and subscribe if you haven't already. And don't forget to share this video with a family or friend you think might be interested in that type of content. Thank you guys so much for watching, and I'll see you next time. Peace!